This is Ian Lamont from In 30 Minutes Guides. Today I'll be talking about dollar cost averaging. It's a way of investing your money. If this video helps, please take a moment to like it and follow me, and let's get going. This is the S&P 500. It looks a little bit scary right now because it's down. You can see that it's down. We're officially in a bear market, so I think we're down more than 20% at this point from the high a couple months back. The thing that dollar cost averaging does is it takes the risk of guessing where the top of the market might be and where the bottom of the market might be. Lots of people try to do market timing, and it does not work that well because you're never really sure if the market's going to keep on going up or it's going to go down. And if you invest all your money at one point, like let's say I had $12,000 and invested it at the top of the market, I would have lost 20% of that. So I would have lost, $2,400 by this point. Dollar cost averaging is intended to take away some of the risk. And basically, here's how it works. This is from Seeking Alpha, and this is a very simple definition that I think works very well. It's that periodic deposits of cash will go to buy shares of an investment at multiple price points, which combine to form an average price. So going back to our S&P chart, you're not just spending $12,000 here or $12,000 here, and you're not really sure what's going to happen. You're spending $1,000 here, $1,000 here, $1,000 here, $1,000 here over a period of time. So let's say once per month, $1,000, and then you're getting the average price. So that's reducing your risk by using these periodic investments. Lots of people do this for their 401ks or for their IRAs. And basically the idea is you transfer or you invest a set amount of money every month. And you're not buying at the top of the market, you're not buying at the bottom of the market, you're buying at the average of the market. And maybe a better thing to do is actually look at the 5-year performance of the S&P. And if you were doing dollar cost averaging either on a monthly or a yearly basis, going back 5 years, you would be getting the average price if you're investing in the S&P 500, like in an index fund or something like that. You can also use it to invest in individual stocks, but if you're here to reduce risk by using dollar cost averaging, a lot of people prefer actually to use index funds, which basically capture the performance of that particular index. So you're not doing any better or any worse than the performance of that index. My name is Ian Lamont. I am the publisher of In 30 Minutes Guides, available from in30minutes.com. We have books about various mildly complex topics, including crowdfunding, Google, genealogy. We also have books about Social Security and personal finance. If you go to in30minutes.com, you can find out more about that. This is Ian Lamont. Thank you so much for watching.